So first of all, our primary thing to do to implement the asymmetry and premium collection is our go-to strategy, which is the out-of-the-money butterfly. Now, what that means is that unlike the way most people think of a butterfly, where they choose to trade it at the money, in other words, they'll take a very, very wide butterfly and then put the short strikes right at the money, and then hope that price doesn't move one way or the other and try to collect as much premium as fast as they can. And while that strategy can work in some market environments, today, that would not be a strategy that you would want to employ today, because you would be a big loser. Plus, you're not gaining the real advantage of the butterfly. And that advantage is your ability to really control your risk to reward. Now, if you want to be a pro trader, and what I know of most pro traders, most pro investors, is that they're after capital efficiency. And what that means is that they want to make best use of the capital that they put at play and have the potential for the maximum potential profit. That may have been redundant, but that's what we're after. We're after small risk, large potential reward. And the reason for that, why we want to take that small risk, is so that we can control our drawdowns, so that we can control our capital expenditure, so that we can make our money that we put and invest as efficient as possible, so that when we lose small. When we win huge. It also allows us, or opens us up to, a path to scaling our strategy. So there are so many benefits to trading this way, and it's the way I've known for 20 years how most pro traders trade. Take the least amount of risk, or limit your risk to the smallest possible reasonable amount, and open yourself up to the potential for the largest potential trade. That's what we do every day. And as I said, with the out-of-the-money butterfly, that is our goal. Now, we have certain standards that we start at in terms of asymmetry. We want to put on trades that have at least a 1-to-9 risk to reward. And the way we come to that is by employing I guess you could call it an age-old strategy from the old-time options traders. When they would put on a butterfly, they would use something called the 10% debit rule. And that meant that whatever the width of the fly was, they made sure that their debit was no more than 10% of that width. So for example, let's say you put on a 30 wide butterfly. Now, when you say 30 wide, you're really referring to just one of the strikes. So it's a symmetrical butterfly, or one of the spreads. It's a symmetrical butterfly, so that means that in reality, it's as much as 60 wide. But one of the spreads is 30 wide, the other one is 30 wide as well. And then you would push it far enough out of the money so that the debit of that fly never exceeds 10%. Now, when you calculate the profit potential of a butterfly, the way you do that is you take the spread width and you subtract the debit. So if you have a 30 wide and you make the debit 1/10 or $3 and subtract that from the 30 wide, you get 27. You multiply that by 100 because that's how it works. That's the multiplier factor. And then that fly, that 30 wide fly, has a potential of $2,700 profit for a $300 risk. Now that sounds pretty outrageous, right? Well, the chances of you actually getting $2,700 are relatively small. You can get somewhere close to it with about a 5 to 7% probability of profit. And you think, well, that's not so great, Ernie. I mean, if I only have a 5 to 7% probability of profit, why would I trade that? Well, that's not the only possibility here. You can make a whole spectrum of returns from 0 to $2,700. In fact, the odds of getting anywhere from 100 to 200% return are very high. The odds of making, say, a 300, 400, 500% return are also very high. Getting that very highest obviously is not going to come across all the time, but it does come every once in a while, and you can make that, and that's what you're shooting for, hopefully, but you can't rely on it. So we're not about high probability trades here. What we're about is what that all relates to or turns into in terms of return. Return is our ultimate arbiter, and the return on such a trade is really fantastic. Your profit factor is very high. Your average return or average winner versus your average loser is typically 2 to 1. Now, your win rate may only be just 50%, 55%, or something like that. Now, of course, if you thought that you were a directional maven and you could tell where the market's going 80% of the time, your returns would be outrageous. But we all know that that's not based in reality. Most people have no idea which way the market's going.